Good day. Welcome to the Macro Anchor podcast powered by the Prague Finance Institute. I am Andre Chelhot, Chief Economist of the Prague Finance Institute. Our podcast is planning to do regular interviews with prominent macro and international economists and geopolitical strategists to understand the ongoing developments in today's world economy. We welcome today our first and special guest, Mr. Torsten Slok, Chief Economist and Partner at Apollo Global Management. Welcome, Mr. Slok. It is a pleasure to have you.
Thank you, Andre. It's fantastic to see you.
Thank you, Torsten. So, shall we start with the interview? The first question I would like to ask you is, of course, after the elections and the results in the US, what are the major implications of the new Trump administration for the global economy and global financial markets? What will be Trump's economic policy towards Europe and China? And do you see any potential black swans with the upcoming new administration?
Oh, thank you. So let's start the answer to that with the broader backdrop of where we are in the macroeconomic cycle. So the Fed started raising interest rates in March of 2022. And what has been particularly striking is how relatively limited impact that has had on the US economy. You would have expected that when the Fed raises interest rates, that car sales starts to go down. That's not what we've seen. That home prices start to go down. That's not what we've seen. That companies' spending, meaning business fixed investment, starts to go down. And that's not what we've seen. So from an asset allocation perspective, what is the biggest surprise over the last 2.5 years is that the economy continues to do so well. In other words, why is it that the US economy continues to be so strong? And there are three answers to that. The first answer is that in the US economy, consumers are simply less sensitive to interest rates going up from the central bank. Specifically, in the US, 95% of mortgages are 30-year fixed rate. So the consequence of that is that when the Fed began to raise interest rates, we didn't see the negative impact on consumers. This has been very different from what we've seen in the UK, in France, in Canada, Australia, almost all other OECD countries. When the Bank of England raised interest rates, as an example, consumers in the UK had to pay more in mortgage payments almost immediately. But we did not see that in the US because consumers are locked in 95% to 30-year fixed interest rates on mortgages. So the first reason why the US economy has done so well is that consumers were simply not as sensitive to the Fed hiking rates as consumers were in other countries to central banks raising rates. The second reason is that in the US, we have an AI and data center boom. This has been very prominent and very strong now for several years. And there are no investors who are saying, I'm not building a data center because the Fed just raised rates 25 basis points. I'm not doing AI investments because the Fed just raised interest rates 25 basis points. So AI has also been an interest insensitive tailwind to the economic outlook, and that will likely also continue to be the case going forward. And third and finally, we also have had fiscal policy has been very supportive of GDP growth. The CHIPS Act, the Inflation Reduction Act, the Infrastructure Act were policies that were implemented in 2021 with the idea of giving a tailwind to the economy in the areas of building manufacturing facilities for semiconductor production, for solar panel production, windmill production, EV production, battery production, anything renewable energy, got a huge tax subsidy, and all those tailwinds, both those things that have actually received the subsidies and also outside of that, things that are in the pipeline, continue to also be a tailwind that has not been interest rate sensitive. So the first part of the answer to your question here, Andre, is that the US economy at the moment is already experiencing quite strong growth because we have less interest rate sensitive consumers, and by the way, also less interest rate sensitive firms. And we have a tailwind from the AI data center boom, and we also have a tailwind from fiscal policy. So now to your question, what are the implications of the election? Obviously, we don't know what policies will be implemented, and we're sitting here in basically middle of November and trying to figure out what might be happening over the next several months in terms of policy implementation. But what we do know is that at least if you talk about and think about what policies has been discussed on the campaign trail, President Trump has now talked about three things. He's talked about taxes, he's talked about tariffs, and he's talked about immigration. So let's in turn think about what are the implications of three such policies on GDP and on inflation, at least under normal circumstances. If you lower taxes, it normally has a positive impact on GDP, and it normally has a positive impact on inflation. So on its own, if taxes are lowered, and we can discuss in great detail where they might be lowered and exactly what any packages might be looking like. But if we have lower taxes coming, it would be positive for GDP. It would be positive for inflation, meaning inflation going up. Secondly, tariffs. Normally, the textbook would say that if you impose tariffs, that means, of course, things become more expensive in the US. But it also means that the consumers in the US will probably be buying fewer of those things that become more expensive. So by definition, at least in the textbook, tariffs means higher inflation and downward pressure on GDP growth. And third and finally, if you restrict immigration, and if, as President Trump has talked about, if you deport in the extreme 11 million illegal immigrants, which is the number of illegal immigrants in the US, you will, according to the textbook, have that if you remove people from the labor force, remember, total employment in the US is 160 million. If you remove 11 million people from that, assuming they all have a job, even if fewer have a job, if you remove many millions of people from the labor force who have a job, it will have the implication that you will have higher wage growth, and you will also have lower GDP growth. So net, taking all that combined, and this is certainly very speculative, but lower taxes means higher inflation, higher GDP. If you take, at least again from the textbook, tariffs means more inflation, lower GDP, and finally, restrictions on immigration means more upward pressure on inflation, and also maybe some downward pressure on GDP. All that combines means that the risks are that there could be some upside pressure on inflation as a result of the outcome of the election. It all depends dramatically on the size and magnitude of these policy areas of what might be done. But I think that this logic that I just ran through is the reason why the trade on the election night, when we just knew just before 9 p.m. here, New York time, that this was the reason why the yield curve started steepening, that people expected long-term interest rates to go up more, and they expected, therefore, that inflation expectations and break-evens also traded higher. So what I just gave is an interpretation of why was it that markets were trading the way that they were. But just to finalize, and sorry for giving a very long answer here, but finalize the answer to a question that we just obviously don't know quite yet. But I think that the market reaction up to this point is probably to be interpreted as there are some chances now that we may get some upside pressure on inflation, and we may also net get some upside pressure on growth. But this all is, of course, very unclear at this point. But the market implications and how markets have been trading, I think, should be at least interpreted in that framework of what are the implications for taxes, tariffs, and immigration.
To comment on your analysis about the US economy, you are right. The growth in the US economy was not affected by the monetary policy, but we saw a rise in inequality. I mean, there is a lot of talk in the market between the haves and the have-nots. And we have seen recently a slowing trend in employment, if you look at the NFP or even at the household survey. How do you interpret that?
Yeah, so one very important backdrop for that is exactly what you're highlighting. So let's first talk about the labor market, and then we can talk about inequality. So the labor market has certainly shown on non-farm payrolls some slowdown here in the last 3 to 6 months, meaning the speed of job growth has been decelerating, meaning coming down relative to where we were, say, 6 and 12 months ago. But if you look at other indicators, yes, I understand that the JOLTS survey of job openings has been coming down in terms of the number of job openings is a little bit weaker. You also see the quits rate, meaning how many people are quitting their jobs voluntarily, has also been coming down. But if you look at, for example, what's happening with jobless claims has remained remarkably strong. If you look at the Challenger Gray and Christmas survey of announced job cuts, meaning they measure every month what is the number of announced job cuts, that has also remained remarkably strong. If you look at in the JOLTS survey, the survey of labor market turnover, if you look at the layoff rate, meaning how many people are getting laid off, has also remained quite strong. So if I put all that up on the scale, combined with a still strong economy, I am struggling a little bit with the argument that the labor market is slowing down significantly, because it is simply not consistent to have a view and say, oh, the economy and the economic data is good. Remember, GDP growth in the second quarter was 2.8. And as we sit here today, the Atlanta Fed GDP now estimate for GDP in the fourth quarter is going to be 2.5. And we also had in the third quarter, GDP growth was just around 3. So net, we still have GDP growth that's significantly above the Congressional Budget Office estimate of long-run GDP, which is 2%. So in one word, a few words, the US economy is good. So you can't say, meaning not you, but the market can, and the Fed in particular has this challenge that they're saying the labor market is not good. Well, how can the economy be good, but the labor market is not good? So the first backdrop for your question is certainly that the labor market, it's slightly puzzling that it's been a little bit weaker on some indicators when you still have strong GDP growth and you still have the consensus, according to Bloomberg, according to the Fed, according to our view. The view is that the economy will continue to do well. Nobody is talking about a recession anymore. So the bottom line is, this has of course meant that job growth has been strong. And to your question about inequality, it has been the case that we have seen some differences in savings across the income distribution, where lower income households, according to Fed data from the Fed distributional accounts, or the quarterly accounts, that is the flow of funds, where you have now distributional data for showing who holds the savings. You've seen that savings have been a bit weaker for lower income households and a bit higher for high income households. So that issue of inequality continues to be an important part of the discussion for the outlook, because obviously there are significant issues about the outlook for the consumer is now become a discussion of what is the outlook for high-income consumers, middle-income consumers, and low-income consumers. But the bottom line, from a macro perspective, with the tailwinds that we spoke about here before, I still think that the broader economic outlook continues to be quite solid, and we should begin to worry about the risk that growth might be stronger, and maybe even the risk that there might now be upside pressures on inflation rather than downside pressures on inflation.
Okay, thank you. To go back to the Trump policy, we know that deficit is now 7% of GDP, and debt to GDP ratio in the US is 125%. And you're talking about inflation, you're talking about wage inflation, and also inflation being maybe sticky. How are they gonna control the path of debt to GDP ratio? Normally, they adopt a financial repression policy, which means negative real interest rates. Do you see that happening in the US?
Yeah, so the US is obviously special in many different ways. And it is special because it's the biggest capital market in the world. It's special because it has, obviously, of course, also a significant defense sector. It's obviously also special because it's the reserve currency for central banks. There are some changes to this. Some countries have been lowering, according to IMF data, their holdings of dollars. But broadly speaking, it is still the exchange currency that's used as a reserve currency for the vast majority of central banks around the world. And therefore, a lot of trade is happening in dollars, and that also makes the US special. And finally, of course, the reason why the US is also special, and therefore the ultimate answer to your question, is because the rest of the world still continues to see, for good reasons, a lot of opportunities for investing in the US. The biggest example of that in the last few years is, of course, the Magnificent Seven. The rest of the world has piled a lot of money into the stocks and financings of AI, of data centers, of the Magnificent Seven stock prices, because the rest of the world views that the US economy is more dynamic, and the rest of the world views that the US economy has therefore more tailwind to growth and more opportunity for returns for investors because of being more dynamic and because of having the 7 biggest companies when it comes to tech, the Magnificent Seven, again, being so strong as a significant part of the US economy. So the first answer to your question is, because the US is special, that means that the US has been able to attract money from abroad. And some of that money has now been going, of course, into financing the US government budget deficit. Of course, we are seeing, according to the Congressional Budget Office, today the budget deficit is 100% of GDP, and the CBO is forecasting that over the next several decades, that will grow to 200% of GDP. So it's absolutely correct, Andre, what you're saying, that the fiscal situation, it does continue to deteriorate, and it does continue to be an issue that is significant in markets, namely who will buy US treasuries as debt levels continue to grow. That's why my answer to that is that I think we need to look at 4 different places for whether this is happening. The first thing is we need to look at what's happening in treasury auctions, because there is no answer to at what level will debt to GDP become a problem. But what we should be doing as the debt to GDP continues to grow is to look at, number one, the strength of treasury auctions. What are bid to cover ratios doing? In other words, what is the amount of money people are bidding relative to what was offered by the US Treasury in auctions? What's happening to tails? In other words, do auction prices come in, the yield levels come in at where the when issue was trading, or do they come in at a level that is higher? In other words, is demand for US Treasuries weaker? Likewise, we also should be looking at primary dealer participation, foreign participation. All these statistics and metrics in the Treasury auctions is something, and that happens throughout the week as the Treasury holds auctions for 2-year paper, 5-year paper, 10-year paper. So monitoring what's going on in these auctions, it does take some time, but I think that is still a very important part for really investors across all asset classes. The second thing to keep an eye on, of course, is the risk of a sovereign downgrade. If there's a sovereign downgrade, that could trigger some mechanical sell-offs by people who have to hold US Treasuries only because they're rated AAA. So if the US is no longer rated AAA, that could have some implications. Third, we also need to watch the term premium. The term premium has been going up. Remember, as you know too well, and you and I have talked about for many years, the term premium, of course, is something that we should be monitoring in many markets, but the term premium measures what is the premium that investors need to be paid to buy long duration bonds in the US relative to buying trades, say 1 year forwards, where you can roll the trade over and get out of the trade and therefore get out of your exposure to long duration. In other words, what is the premium people are paid to take duration exposure in US government bonds? If that goes up too much, that means that people are beginning to say, I need a higher premium to buy long duration government debt and therefore invest in long-term government bonds in the US. And finally, the most important perhaps one is what's happening to the dollar. The dollar so far has been very strong, and I would expect it to continue to be strong because US interest rates are higher than what we're seeing in Europe, what we're seeing in the UK, what we're seeing in Japan. And for that reason, it attracts money that wants to have higher yielding interest rates, namely US Treasuries. So for those 4 reasons and those 4 areas, I still think that these are the areas that we should be watching and monitoring for whether how long time can the US government continue to grow the debt level. But so far, on all 4 fronts, Treasury auctions are still solid. You have that sovereign rating agencies, of course, still have a AAA rating or the highest rating on US government debt. The term premium has moved up a little bit, so we're watching that very carefully for signs of more steepening in the yield curve. And fourth and finally, the dollar has certainly also been strong. So overall, so far, things are still looking good when it comes to demand for US Treasuries, but we should all be watching in markets very, very carefully what's happening on these 4 different fronts, because these will be the areas where we will begin to see if there are some signs of cracks or weakness, where you could have a situation where things could become non-linear, meaning where in the worst case, markets could change their views overnight. And there are a number of situations, of course, in history. We've seen that of course, in Greece, more prominently here, a little bit more than a decade ago in Europe, where for a long time, people didn't worry in markets about the debt level, and suddenly they did worry. We've also seen that the path in emerging markets, Turkey, Argentina, South Africa, countries that have gone through various debt crises. This, of course, is something that is not unprecedented, but the issue really still is the US is special. And as long as the US is the most dynamic economy with high growth rates, high interest rates, and continues to still have the strong outlook for growth and returns on investments, then I do still think there will be financings of US government deficits.
Thank you. So now my last question on the US economy, I'm going to move to the Federal Reserve. The Fed has cut interest rates by a total of 75 basis points. And if I understand what you are saying, it seems that you have a view about the Fed policy to be less dovish, let's say, from what the market is expecting. But there is a discussion now in the market about the interference of the next administration in the Fed policy. And last week, a very clear question was asked to Mr. Powell, saying, if Mr. Trump tells you to ask you to leave, would you leave? And his answer was no. And Mr. Trump, President Trump, he has expressed his wish to be sitting on the table when they decide interest rates. My question here is, one, is the Federal Reserve going to lose a bit of its independence? And second, the Federal Reserve will be obliged to adopt a policy of negative real interest rates in order to make the debt trajectory more sustainable?
So I think that what Jay Powell's response was very telling for what I think will happen, namely that the Fed keeps on focusing on its dual mandate. The Fed has been asked by Congress to make sure that two things happen. The Fed has been asked to have inflation at 2%, and the Fed has been asked to create full employment. So the Fed would say, and this is what Jay Powell has repeatedly said, this is what our job is. This is what we, as he says, always squarely focused on delivering that dual mandate to the American people. Now, to your question, of course, there's a lot of discussion about what can happen and what might happen and what could potentially happen under different scenarios. But I think that the Fed, and in particular the Fed staff, they will be very, very laser focused on sticking to the dual mandate and making sure that their job is, no matter who is in the White House, no matter who controls Congress, their job is to have inflation at 2% and have full employment. And there has been some discussion at the highest level, if just ignoring even the Trump election for a minute here, of fiscal dominance, that when you have that debt levels continue to grow, and the central bank normally takes interest rates up and down as a function of the business cycle. But if suddenly debt levels become so high that if you begin to raise interest rates, then it begins to become damaging because you have to then increase, of course, debt servicing costs when interest rates are higher. So fiscal dominance means that fiscal policy and debt levels dominate what monetary policy can do. We have some version of that in Japan, where debt levels are more than 250% of GDP. And if the Bank of Japan raises interest rates, it would mean that you would have a significant increase in interest payments. So the dynamics between fiscal policy and monetary policy are getting slightly more complicated, but mainly because of the fiscal dominance risk, namely that if debt levels go up, then that could begin to complicate the Fed's job in terms of how much freedom do they have to raise interest rates if there were to be an increase in inflation. But broadly speaking, the answer to your question is that I think the Fed will be very focused on delivering the dual mandate. And Jay Powell's answer, as you just mentioned, of no, he was not going to leave. I do think that at least if it is difficult, given that answer, to imagine that other scenarios, at least in the near term, are more relevant. So I still think the Fed will continue to fight their battle of getting inflation down to 2%. And making sure that we keep employment as strong and therefore as close to full employment as possible.
One remark here, if I can, if I may, there is a third mandate to keep long-term interest rates relatively low.
Well, the mandate is to also, they certainly also have a job to maintain financial stability. So if there is a risk to financial stability, then they have previously, we saw that in 2020, stepped in and done QE. And that's, of course, why to the part of your other question, well, would they do QE for political reasons to keep interest rates low? And I think that is extremely unlikely. So in that sense, yes, the QE instrument, which has certainly been used a lot in Europe, where the ECB has been buying Italian government bonds, Spanish government bonds, and buying government bonds of different countries, where you look at it from the outside at least and say, well, why was this done? And the argument was that it was done to maintain financial stability. So the short answer to your question is yes, there are other things that the Fed also needs to look at, but they have certainly not been doing yield curve control the way that they have done in Japan. But if there are risks to other things that impact inflation and unemployment, they could certainly also begin to act as we have seen them do before.
Thank you. Okay, let's move now to Europe a bit. And we see a divergence in growth between US and Europe. We also see a divergence in growth between the service sector and the manufacturing sector, be it in the US or in Europe. But we know that Europe is more geared towards manufacturing than services. So what are the challenges for the European countries' economies, in your opinion?
Yeah, so I think that if we just concluded that the US outlook is characterized by three things at the moment, namely lower sensitivity to interest rates going up, we have a tailwind from AI data center boom, and we have a tailwind from fiscal policy. none of these things are the case in Europe. We do not have lower sensitivity to interest rates in Europe. We have very high sensitivity to interest rates in Europe, in France, in Netherlands, including even in Spain, to some degree also even in Germany, also in Italy. When the ECB raised interest rates, it had an impact on mortgage payments much faster than what we saw in the US. Likewise, we do not have an AI and data center boom in Europe, and we do not have easy fiscal policy in Europe. Remember, in the US, the budget deficit at the moment is almost 7% of GDP. In Europe, because the Growth and Stability Pact limits our budget deficits in European countries to 3% of GDP. That means that we have a bigger budget deficit in the US. That means that we already have three very unique forces pushing the US economy forward that we simply don't have in Europe. Instead, in Europe, we have a number of headwinds that are holding the economy back. Exactly as you're saying, we have some headwinds with the differences between the manufacturing and the services sector. We also have some headwinds with energy transition. Getting off Russian oil and gas has still turned out to be more complicated for European businesses. And third, and finally, we also have a headwind because of the auto sector, in particular in Germany, but in Europe, generally speaking, struggling with competing with not only Tesla and US automakers, but certainly also, of course, with BYD and the Chinese automakers. And because of these structural headwinds, we simply have the unusual macroeconomic situation that the US is powering ahead by some tailwinds, whereas Europe is unfortunately being held back by some headwinds. And this is really unusual. When you and I have been talking about this for the last 15 years, we have always been agreeing that, well, when the US is good, Europe is good. When the US is bad, Europe is bad. So that highly synchronized business cycle that we all thought were playing out and were basically a phenomenon and a characteristic of the global economy forever, that is just now no longer the case, because we have some really unique forces powering the US and we have some really unique forces holding back Europe. And the consequence of that is that US interest rates will stay higher for longer. European interest rates are going to come down faster. The ECB will be cutting interest rates still over the next several quarters in order to counter these headwinds. And the net result of that from an FX perspective, at least most likely, according to the textbook, would be if you have one economy, the US, with high interest rates, you have another economy with weak and low interest rates and declining interest rates, that of course would mean that the dollar will be going up as a result of that. So that therefore ends up with a summary of the answer to your question is that the US is doing good, and Europe is unfortunately not doing very good.
Okay, thank you. We move to my next question. China has announced a massive fiscal and monetary stimulus at the end of September. What's your take on that stimulus first? And is it going to succeed to revive the Chinese economy? I would like to make a comment here is that it did not address at all consumption spending. And it was all about investment spending and production. Please give me your thought about that.
Exactly. So the answer is this going to help and make a dramatic difference? The answer is no. The backdrop for China is that they are suffering from three headwinds. First of all, they have demographic headwinds. The one-child policy is beginning to kick in when it comes to the labor force. Today, the total labor force in China is about 1 billion people who have a job, and the United Nations is forecasting that over the next 10 years, that will decline to 900 million. In other words, the labor force will shrink by 100 million people. That's a pretty dramatic decline in the total labor force in the Chinese economy, again, according to the United Nations. What are the implications of that? The implication is, of course, that we have 100 million people fewer working in factories, in service sector jobs, 100 million people fewer paying taxes, 100 million people fewer basically being part of the economy that produces, and instead moving in to the older generations that are not working and instead, of course, are therefore retirees that now also potentially depend on government pensions. So this is a very unique headwind to the Chinese economy, namely that the demographics, because of the one-child policy, which has already played out now for the last 5 years, is going to be a continued headwind. This, again, as a footnote, is very different from the US, where immigration since January of 2020 has gone up by 5.5 million. In other words, we still have positive immigration into the US, whereas we have negative population growth in China as we speak. I do appreciate that President Trump can make some changes to the immigration outlook for the US, but the broad conclusion today is that the headwind to China from demographics just continues to be really strong. The second problem in China is that they also are experiencing housing disinflation, meaning home prices are coming down. Home prices for existing homes are falling 10% year over year. Home prices for new homes are falling 6% year over year. We all know from the US experience in 2008, when home prices go down, it begins to have implications. And that's what we're seeing on financial institutions in China. It begins to have implications also for people, of course, who own housing, see the asset values or home prices come down, means that their savings are beginning to decline in value. So housing is slowing or coming down, but at the moment quite quickly, is also a major headwind to the Chinese outlook. And finally, China is engaged in a trade war with the US and Europe. We've seen that in particular with Europe now putting tariffs on BYD cars imported into Germany. So all those things combined means that China is facing some headwinds that are quite strong and therefore putting downward pressure on growth, again, for demographic reasons, because of the problems in the housing market and because of the trade war. There is a footnote here that China has been switching, as you said, Andre, away from the consumer towards exports and tried to get a more consumer-led growth outlook. But the problem for China is that shift away from exports, it has moved certainly to, again, EVs, to different industries and sectors where they are now more technologically advanced than where they were before. But the problem is that if now the gates are going up, both in the US and Europe, to importing those goods, then you may be the good producer of EVs or batteries or technology. But if the rest of the world has now decided, in particular Europe and the US, that they don't want to buy goods to the same degree anymore, then that's not going to help their growth prospects either. So the bottom line to your question is, what can be done from a policy perspective? Well, you need to counter these things. You need to counter demographics. That's really difficult. You need to counter in the housing market by trying to lift housing construction and try to get home price to move up again. That is also quite challenging and requires potentially a very significant bazooka stimulus that they, at least in my interpretation, is not what we have seen at this point here, again, sitting in the middle of November 2024. And finally, on the trade war front, it doesn't look like, with Trump being elected, that this is also going to get better anytime soon. So the headwinds to the Chinese economic outlook, unfortunately for China, it continues to be quite strong.
Okay, I want to move to Japan because the story about demographics is kind of similar in Japan, and Japanese population is also contracting. Recently, the Bank of Japan has ended the period of negative interest rates, and they're trying to raise interest rates. And we noticed that wage inflation in Japan is becoming sticky and high. What's your outlook over there? Will the Bank of Japan let inflation be above target, and this will maybe it will help the Japanese government to reduce its debt to GDP ratio? What's your take on that?
Yeah, so the backdrop, of course, with Japan is that they have had very low growth for a very, very long time, and they have had zero interest rates for a very long time. Then suddenly came along COVID, which lifted inflation everywhere. And everywhere at least in the US, Europe, Australia, Canada, around the world, the UK, we saw, of course, that central banks begin to raise interest rates in response to the rise in inflation because of COVID. But we did not see that in Japan. So that's really unusual. And that's, of course, the reason why the Japanese yen weakened so much, because Japan decided, the Bank of Japan, to not raise interest rates when everyone else was raising interest rates. And the consequence, of course, was that the yen got weaker and weaker and weaker because investors globally said, I don't want to invest in a currency that yields zero. When I can go to the US and get 5%, I go to Europe and get 3-4%, and likewise the UK. So therefore, a lot of money were flowing away from Japanese yen and into higher yielding currencies. And that resulted in a lot of downward pressure on the yen. That downward pressure on the yen then has in turn created some inflation in addition to the COVID inflation we saw. So that's why the tricky thing for the Bank of Japan has been, well, how much of the inflation that they have seen has come because of the depreciation of the yen? And how much of the inflation that they have seen has been because of domestic demand being strong? So this is the classic macroeconomic challenge for a central bank. Should I raise interest rates in response to higher inflation? Well, that depends on what is the source of the inflation. If the source of inflation is that the domestic economy is overheating, you should certainly try to cool that down by raising interest rates. But if the source of the inflation is because of external factors, say your exchange rate goes down, and therefore things just become more expensive, then raising interest rates by the Bank of Japan is not going to help slowing down domestic demand, because that's not the source of inflation. The source of inflation was the currency depreciating. And I think that the Bank of Japan has come to the conclusion that an important reason why inflation went up, it was because of external factors, meaning the exchange rate depreciating. We have since seen, as you said, Andre, that wage inflation has started to move higher. It has turned out to be more sticky for a number of different reasons. The labor market in Japan is quite different from the labor market in the US. So if it is now more difficult to get inflation under control because you have jolted inflation into a higher level and expectations of wage inflation, expectations of inflation being at a higher level, then you would expect that the Bank of Japan does begin to think more about that maybe raising interest rates to get that sticky inflation down again could be a good scenario. But there's been, on top of that, some political challenges. There's been some issues with, again, well, what is now the global economic backdrop? So where we sit at this point, the Bank of Japan has continued to be, and I would expect it to continue to be, very reluctant to raise interest rates in response to the higher inflation that they have seen. And exactly as you also highlighted, because in Japan you do have more of a fiscal dominance because debt levels are so high, which is causing problems, of course, also for the Bank of Japan. If they were to raise interest rates a lot, it would, of course, mean that the debt servicing costs would go up a lot, and that would, of course, create a lot of problems for the economy more broadly. So the short answer to your question here is that I think that the Bank of Japan is going to still stay on hold and wait and see if there is a need to raise interest rates, or whether they can, just like the rest of the world has been seeing more recently, try to get inflation to go down under control over the next several quarters. It still remains to be seen, and that's why it's a good question you're asking. We just don't quite know what the path will look like. But for now, I still think they will be reluctant to raise interest rates further.
Okay. My last two questions have to do with global economy. First of all, what do you think about the theme that is going in the market about the de-dollarization and the rise of the BRICS and the threat to the US dollar as a reserve currency? This is my first question. The second question is trade wars. If President Trump enacts its policy of 60% tariffs on Chinese imports, we should recall that China produces 70% of rare earth and silicon in the world. China can retaliate and say, well, you know, we are banning exports of rare earth and silicon. What would be the impact on the global economy? This is, in my opinion, a massive negative supply shock.
So, to the first question about reserve currency status, as we spoke a bit about earlier, I still think the US will remain the global reserve currency. And that is, to a large degree, mainly because the US is still the most dynamic economy in the world. It still has, think about the Magnificent Seven, at least from a market value perspective, the biggest companies in the world are here in the US, and they are still very productive, and they are dominating in their fields, and in particular in the field of technology, combined with growth and returns generally expected to be higher in the US. I still think that at least where we sit right now, it seems most likely that the US will be the reserve currency of the world for a very, very long time. And to your second part of your question, which is related, is that, well, with that backdrop, we have certainly seen some moves in global trade, including from China and Russia, of trying to invoice not in dollars, but invoice in other currencies, in RMB, in broadly speaking, rupee, in other currencies around the world that could play a role. But ultimately, a lot of that ends up still coming back to dollars, which is probably the reason, again, why the dollar has continued to trade so well. So, and I do understand, to your point, that the trade wars, it is still very, very early. We will have to wait and see exactly what, if anything, President Trump will do. Lighthizer has been talking about fairly extensive trade wars. If they do that, given what I spoke about earlier, the textbook would tell you if you have a trade war, prices go up, GDP goes down. That's perhaps not desirable from a policy perspective, but let's see what we get overall. And if we do get something that is more substantial, then I do, to your point, absolutely would expect, just like we saw in the 2016-2018 period, to see retaliation by China and others, and what that could look like on rare earth and things that come into silicon, etc. And what's happening on that front is certainly something that I think will be a very, very important area to watch. In other words, investors should not assume that the trade wars that the US is engaging in here will not come with some retaliation. So that's why what that retaliation will look like will certainly, there's a huge question mark around that, and will certainly be something that I totally agree with is very important for global investors.
Dr. Slok, thank you so much for your interview and for your time. If you want to add something or a comment on what we have discussed, please do so.
I just want to say thank you so much, Andre, and I really appreciate it. It was great to talk to you, and I hope to talk to you soon again.
Yes, we hope also to have a podcast with you again soon. Thank you very much, Mr. Slok from Apollo Global Management. Thank you.